Hello and welcome to week 4 of Flow Powers on the Spot. This week, the usual host, Nathaniel, won't be here, so I'll take over the hosting duties. My name's Aidan Moore, and I head up some of the wholesale activities here at Flow Power. And joining me will be a familiar face who joined us in week 2, Alex Lehman. Welcome back, Lemo.
Thanks, Aidan. Good to be here.
How's life been in the last few weeks since we spoke? 2 weeks down the track in terms of quarantine?
Was it only 2 weeks? Could have been 2 years. I have no concept of time at the moment.
I miss you too, mate. I miss you too. So really looking forward to this discussion. Today's on the spot. We've covered a few topics in the first few weeks, but today will be a look back at the month of April from a spot or a physical market perspective, and also a little bit of a look at the futures or the forward market. So probably very timely for many of our audience, anyone who's looking to lock away a retail contract or who has an interest in the spot market. So yeah, really looking forward to picking your brain, Alex, and to hearing what's been happening, because lots has.
Yeah, it's certainly pretty interesting times in the market at the moment.
Let's just take a quick recap in terms of who Flow Power is for anyone who's joining us for the first time or who might have forgotten. We are an electricity retailer. We sort of come at things slightly differently to the vertically integrated traditional retailers, and we do see ourselves more as sort of an energy management partner to help customers sort of navigate the wholesale market. And our former topics that we've covered, obviously looking at the PPA space and the renewable energy space, a key area of our business. And also we've had Alex on to talk about the summer that's been from a demand response and an ancillary services market perspective. So these are some of the key areas that we focus on, but at our core, we're also an electricity retailer. If we look at we've been showing a bit of a matrix in terms of some of the topics we've been touching on and intend to touch on over the coming weeks as these on the spot sessions continue. And so obviously today's market recap for the month of April will be in that top left spot. So really looking at the spot market and the contract market as well, though clearly very interconnected with the other boxes and areas as well. As we progress through this session, I'll about to hand it over to Alex to run a poll. So we will have a couple of poll questions to pick your brains, but any questions that you have, if we're not getting to answer your questions in the material, just post them in the chat window or the question window, and we'll pick them up for a short Q&A at the end. So we're looking to run the session for about half an hour or so, give or take. So Lemo, hit us with the poll.
Great. So if anyone's been seeing any energy media coverage, you will have seen that electricity prices are incredibly low, especially in the month just passed. So I thought we'd put a little poll to get the feel for where people think what's causing that. Do you think it's all COVID-19 coronavirus related? The rise of renewables, both behind the meter rooftop and the utility scale? Some people who are really watching the energy markets may have seen we've got some very low fuel prices around at the moment, especially, oil is publicly low. Or is it a combination? Is it something else? We'd love to hear what you think is causing very low prices in the market. Throw us your wildest conspiracy theories.
Yeah, anyone who's ticking the other box, if you want to put into the question window what you think it is, let us know. A few responses trickling in.
Yeah.
I'd say let's go to the results. Clearly, COVID has caught a lot of the headlines, but what do people think?
We'll share this. So yeah, quite a few of the COVID renewables, low prices, but a fair few people think it's a combination of all of those, which is the smart money. Keen to hear some of the other thoughts on what could be driving incredibly low market prices. it's always great to have different perspectives over what impacts the market. So I think now we might jump over and we'll have a chat about some of the trends we've seen in April, demand trends. So what we're looking at here is we've got some charts that show the median demand for April for each hour of the day for both 2020 and 2019. So the orange line is the April just passed. And what we can see is a couple of really interesting trends that are sticking out. So the first is that every state is showing a pretty clear reduction compared to April last year. In some states, some very significant reductions, particularly there in New South Wales in the middle of the day. But what's really interesting is that the morning and evening peaks, particularly in the southern states in South Australia and Victoria, are really quite close. You know, there's very limited change from last year. So it's quite interesting to see that the duality and the peaks is still very present in the demand. So obviously coronavirus can't be having too much of a massive impact on our daily demand habits. And so it's interesting to see that they're present in the data. I think we don't have the context here in these charts, but what we're actually seeing is in all states except for Queensland, we're seeing some of the lowest median demand of all time for an April, sort of at near record lows for this time of the year. And we can strongly see that there's what we talk about, the duck curve. So that the deepening of the belly of the duck in the middle of the day. And we see this as part of a trend of that demand being hollowed out. And you can see it's sort of exacerbated from last year to this year. So probably one of the key takeaways and one of the key things we're seeing is that there's no sort of very clear, very distinct COVID-19 impacts on demand that are immediately recognizable, but it's a very steady and continued trend from previous years that we're observing in the data. And coronavirus is sort of one additional impact potentially that's adding to that.
Yeah, so Alex, this is scheduled demand. This is the demand that the system sees rather than native demand or natural demand when you add back in rooftop PV or small non-scheduled generators, right? So this is obviously, yes, there has been a significant increase in behind the meter solar with record levels even over the last month or so based on SDC creation levels. So that's going to be having a significant impact quite clearly through the middle of the day. So it's fascinating. I mean, I don't know if you know the percentage change April over April or even March over April off the top of your head, but we were seeing forecasts suggesting demand plummeting in the NEM for the months of April, May, June as sort of corona economic slowdowns really set in. But do you see, is this data telling us that there is falls of 10, 20, 30% demand declines?
I don't have the precise percentage figures on me to hand, but we aren't seeing those hugely drastic
right.
falls. Certainly, so there is obviously a slowdown in the economy, and there's a big shift in people's working habits and the way we use electricity. But I think what the data certainly represents is there's not a sustained or incredibly strong impact on demand. And a number of other media organizations have reported similar findings, that it's very hard to tease out clear conclusions. I think you can certainly think from a high level perspective or anecdotally that even if we have an increase in working from home, that residential increase in residential demand is still doesn't or perhaps makes up some of the gap of load that has been taken away from reduced hospitality particularly. And there will be a handful of other industries that have certainly slowed or shut down partially.
Right.
What
but
I think
in terms of the big industrial slowdowns, smelters, the very large commercial, very large industrial loads that really underpin the NEM, we haven't seen a major stagnation or slowdown in the data at this stage.
No, we certainly haven't. No, we haven't seen that yet to come. Whether that will still come as things progress in the economy.
Yep. Yep. How do temperatures and weather patterns, April 20 versus April 19, sort of influence this data and perhaps distort or contribute to the differential that we're looking at?
Yeah, that's quite interesting. What's Queensland and New South Wales are roughly the same temperature as last year, so they've only 1 or 2% change. Whereas in the southern states, so both Victoria and South Australia, we're looking at around 10% colder mean temperature compared to April last year. So it's quite possible that we're seeing some of the impacts of that in the data. Colder weather does tend to mean that people are using more heating, and some of that heating will be electrical, although we do know that heating in Victoria is often made up from gas heating. The other interesting thing is whether we can tease out any impact of rooftop solar in morning peaks. So it's interesting to see that the morning peaks are significantly down in both Queensland and New South Wales. Right now in Queensland, the sun comes up about an hour earlier. So you will see the impact of that rooftop solar on the scheduled demand curve earlier than you'll see it in the southern states. So that could be another interesting impact.
Yeah, so I suppose demand, the big takeaway from me really is that, the continued influence of rooftop PV and behind the meter, that's having a massive impact on daytime demand quite clearly. But otherwise, the needle hasn't been moved significantly from demand from a COVID-19 perspective at this stage. Very hard to unpack it from those other drivers and those other influences, but we certainly haven't seen the cliff edge for demand that was sort of initially hypothesized to come.
Yeah, no, absolutely. If there are any doom and gloom scenarios that were being floated around by pundits, we certainly haven't seen that eventuate in the data. We've got some supply side might be worth looking at. I think tells the other side of the picture, and perhaps this goes some way to help explaining some of the profile and demand. So here we've got a pie chart showing the percentage contribution of all of the supply providers across the entire NEM. So you can see that the NEM is still very coal heavy. We're looking at around 70% of all generation was provided by coal, but you can see in the middle section there, the yellows and the green and the blue are renewable generation, and again continuing this trend of significantly increasing shares of renewable supplies in the market. In the table to the right, we've got the year-on-year change, and those are some very big numbers, particularly in solar, the change. So we said before that we felt that the change in that belly of the duck deepening was largely due to behind the meter rooftop solar, and the figures show that we've seen a 26% increase in rooftop solar. That's an estimated number, but it's still a very large number there. But we've also seen a number of utility scale solar projects have come online in the last 12 months, and an increasing number of wind projects at a utility scale that have come online, which have led to this significant increase of renewables playing a part in supplying the grid.
Yeah, I think the numbers recently published suggest many hundred megawatts commissioned during Q1 and more to come into Q2. So, that trend obviously expected to continue in the near term, subject to any disruption to the commissioning process as a result of COVID.
Yeah, certainly. It's also one thing where we'll just sort of make a comment here for those who really watching the supply across the NEM. These numbers are all NEM wide, so there is some discrepancies when you actually dive into the regional level. So you can see there's a 33% increase in the hydro units, which is huge, and a lot of that's actually come from the Tasmanian units are increasing a fair bit more rather than say the snowy units in southern New South Wales and northern Victoria. So and likewise, the gas is varied. We've seen an uptick of gas supply in Queensland, but a reduction in some of the other markets of supply by those various fuel sources.
Yeah, I think what this data at a NEM level probably hides and buries some of the detail around those low thermal fuel prices that you have had such a decline in gas, arguably some mild influence of lower Newcastle coal prices, though they probably take much longer to trickle through to New South Wales coal gens. And so buried in this data is that the short-run marginal cost and those bid levels from thermal generators have reduced And yeah, region by region, it is a little bit different, but that has a significant influence when those generators are the marginal generator or they're setting the price, like they often do in slightly higher demand periods.
Yeah, absolutely. And in fact, the change in gas price has been dramatic. We're compared to this time last year, we've seen nearly a 50% reduction in the domestic gas price, which will obviously have a significant impact on gas generators who are buying gas on the spot market.
Yeah, huge. I mean, if the price has gone from $8 a gigajoule down to $4, yeah, it means you can basically generate at sort of $45, $50, and potentially even lower on some days, subject to the spot price. I think Victoria, the last couple of days, with some of the milder weather that we're having, the last couple of days relative to typical May temperatures, and that sort of weaker heating load in the state. Has prices in the threes even. So going to be very interesting to watch gas prices domestically over the next couple of months and to see where they may go, given the potential oversupply at a global level in the Northern Hemisphere and how much of that gas gets dumped into the Australian market and used by generators here. So yeah, certainly anyone who answered or included fuel prices in their thinking in the poll question, I think certainly very spot on in one of the major drivers there, and trickling down from the north of the country to the southern NEM regions progressively as well.
Yeah. Speaking of prices, let's actually have a look at what we've been observing in the spot market prices. So this is the data presented in the same format as previous, but now we're looking at the median prices for April, comparing 2020 to 2019. We're looking at the median here so we can take out the any unexpected spikes that are caused by when you look at the average prices that can skew quite dramatically. And we can see a very, very clear reduction from 12 months ago. You know, the lowest reduction there in Queensland is around a $20 per megawatt hour reduction across the day. And in Victoria, we're looking at closer to around $50 per megawatt hour, which is huge reduction. Again, not shown in this data, but the prices here, so these median daily prices in April are around, they're the lowest we've seen in 4 years. So we're going back to pre-Hazelwood days. Those of you who watch the market closely will know that energy prices have increased significantly since Hazelwood closed in March 2017. But in fact, looking at the data, the daily prices, we're seeing prices that are back around original levels of when the NEM started 20 years ago. So we are looking that they're not record low, but they are close to some of the lowest prices we've seen, certainly in a long time, which is really quite fascinating.
I mean, particularly the reversal in the market, you know, heading through 2019, obviously Q1 19 was exceptionally high in South Australia and Victoria, the other regions relatively high as well. And then the speed at which the market has fallen in the last couple of months, and now where it sits is staggering. I mean, take a look at that differential in Victoria. I mean, if you run your average number through the April 19 versus April 20, it's probably a $50 a megawatt hour differential, quite staggering and consistent in all intervals, and not too dissimilar in the other regions as well. I mean, yeah, it's a 50% haircut. That is a big step change.
Yeah, no, it's certainly the most significant thing that we've seen in many months. What's quite interesting too is if we think back to those demand curves, we can actually see some of the shape reflected. We saw reduced morning peaks in both Queensland and New South Wales in the demand curve, and we can actually fairly clearly see that reflected in the price curve. The very low morning prices in both Queensland and New South Wales, and again, it's a little hard to draw definite conclusions, but it certainly looks to me that there's a softening of prices in the morning intervals generally, which could align with people waking up a bit later, wandering into the kitchen, making a coffee, and then starting work in their pajamas, relative to people's work habits when they have to head into the office. I think we can see some of that delayed start. What's also really interesting, and again, we talked about the duck curve, and we've talked about this in previous webinars and here at Flow Power, but if we look at the midday prices, the median prices during midday, they are currently lower than the nighttime prices in all markets for April then, except for Victoria. So, you know, traditionally we know that prices are low over the middle of the night and very early hours of the morning, but here we're seeing incredibly low prices during the day that are even lower than those historical periods, which itself is very interesting.
I mean, the market's changing, right? And changing very fast at the moment in terms of prices, but also that shape quite clearly. We've had one, we're seeing the questions roll in, so thank you for those. There's a comment here around, well, spot, I mean, I'm sort of paraphrasing here, but spot's great, but it's only a single data point relative to the contract market. So probably a very good segue for us to jump across and look at what's been happening in the ASX market. As a proxy for retail contracts. So obviously these are contracts for electricity for delivery from now right through till the end of 2023. Quarterly prices, a snapshot taken on the 1st of April and then a snapshot taken on the 1st of May. And so you see a couple of interesting things. Obviously, we've spoken about on other sessions of On the Spot how prices have been progressively declining since late last year. This only shows the change month over month, so it's a little bit smaller a time frame. But generally, what you do see is that prices are net lower on a calendar year or a financial year strip basis. But there's a little bit of detail buried in there, sort of like that NEM-wide generalization in terms of the smaller contribution from some of those thermal gens. We've got to look a little bit closer than just simply saying that a CY contract is down $1 or $2 a megawatt hour between the end of April and the start of the month. And interestingly, you've seen Q2s, Q3s, Q4 contracts continue to track lower, and they've opened quite a sizable discount on where they started the month of April. But the Q1s have held up pretty well in most regions, and if anything, when you look at the New South Wales, the South Australian and the Victorian charts, particularly Q1 21, you can see that the Q1 there is higher at the end of the month than where it started. So we have seen risk premium start to be added back into those Q1s. They did sell off fairly heavily. Alex, I mean, you managed the demand response desk here at Flow Power through Q1, and there was certainly a few hairy days, but by and large, it was a bit of a fizzer. And so that does have a habit of sort of snowballing into the market and contributing to that, or I suppose being picked up by the forward market. So perhaps now with a bit of breathing space, buyers coming back in there, seeing value and adding risk premium back into the front couple of Q1s that's supporting price. But outside of that, Q2s, Q3s, Q4s have probably tracked a little bit lower over the month. And so again, the curve, if we take the curve as sort of a CY or a financial year strip, represents still the sort of lowest prices that we've seen for the last few years.
Yeah, do we have any indication of the kind of buyers and sellers of these contracts, Aidan? Are generators willing to sell these contracts at such low prices?
Yeah, I mean, great question, right? These generators would have had an opportunity to forward hedge their revenues at double these prices, I suppose, 3, 4, 5 months ago, progressively out along the curve, depending on how far their risk policies allowed them to sell. And so now to be coming into this market and to be selling would be to be taking a 50% haircut. Now some generators, their fuel costs might have reduced, so they may be able to still maintain some of their previous margins. But you do expect that on the sell side, that physical players or generators would be less willing to be selling at these levels, simply because the market has fallen so far, and in some cases, I suppose, yeah, they'll be locking in very low margins relative to where we were previously. On the buy side, I certainly think you've started to see buyers come out of the woodworks over the last few weeks, and so prices up slightly, probably over the last 7 days, last 2 weeks, depending on even on some of these Q2, Q3, Q4 contracts. So I think we are starting to see some of the buying interest, and whether or or not that's speculators themselves or retail buying, retailers supporting their retail load, hard to unpack. But the time of year, the fact that we're not so far away from the start of the financial year with many people that have contracts that kick off on 1 July suggests that there's probably a bit of a combination of both. Maybe some speculators closing out positions that they'd sold on the way down and realising those profits, and as well some natural buying there from retailers looking to hedge their retail load. Of course, the market is fairly opaque. Over-the-counter traders may have a better understanding of who's selling and who's buying based on who they're getting hit on the other side. But from the futures market perspective, obviously, you don't know who's on the other side.
Mm. So what's
and again, the other point to make is that generators obviously forward hedge, right? So they're less exposed to the immediate prices in the near term. It will take time for them to have more spot exposure as those contract positions roll off.
That's true. I wonder if perhaps some of these very low contract futures are encouraging some generators to consider taking merchant risk in the future, or how that plays into their strategy moving forward.
Yep. Yeah, exactly right. So I think that they'll be running their own value models, trying to understand exactly if there's value in the forward curve at current levels, and if they want to be selling or sitting out of the market. And obviously on the customer side, we're doing the same, and that sort of tick up in prices in the last week or so suggests that, yeah, people are seeing good value there at the moment. And we'd certainly echo that sentiment from a retailer's perspective. I mean, you've seen all the reasons why the market's fallen. Some of them obviously systemic and sort of long-term changes in the market. Very hard to unpack the COVID influence. Maybe some sentiment there, hard to tell, but either way, prices represent pretty good value right there along the curve. And so, yeah, we would be encouraging people to be thinking about their long-term retail deals at the moment.
Yeah. So what's the takeaway from all this? Where can customers get the best value on their retail contracts? What positions should they be taking?
Yeah, well, I mean, short term, clearly spot. I mean, you can see that Q2 20 contract has moved lower over the month, and that's obviously based on what's been happening in the month of April, and also an expectation of what will come in May and June, the balance of Q2. But you'd have to say in the short term at least, yeah, I mean, spot exposure for the next couple of months looks to be a reasonable approach, but by and large for most customers it will be to be looking for long-term retail deals with their retailer to take advantage of the falls along the curve. Obviously, I think we had the Flow Power ran a webinar yesterday talking about businesses who might have slightly less certainty in terms of their business operations if they have been influenced by COVID, and so they may be looking for more flexibility in their contracts and less willing to go long term at the moment. But for the other businesses where it's more business as usual, or at least a greater likelihood for operations over the coming months and quarters, certainly be suggesting they can look longer term.
Yeah.
Should we throw to a poll? We've got we've got a few questions there which we'll touch on after, but maybe just a quick poll to the audience around when you think forward prices represent when they'll hit their low. April is the first option there. You think that maybe there's a little bit further to fall, May and June. Maybe you're a bit more bearish that there's 6 months time to go for the forward curve in terms of it will fall in the second half of this year. The other option there, 2021 and beyond, so some long-term bears there, or the last option there, don't know. Just give you a few seconds to complete that. Yeah, so I think we're starting to see those answers roll in now, and not many think that April was the low in the market, so everyone's still a little bit pessimistic there. 38%, so a little bit over a third, think that May to June, sort of potentially the depths of the economic slowdown perhaps, or as we start to recover, that will be the lowest point, and arguably based on delayed impact of that oil indexation in gas prices. That's potentially when fuel prices may be at their lowest as well, and that could be influencing the forward curve through that point. About a quarter of you think that 6 months' time is when we'll see it. So the back end of this year is when the curve will bottom, and a few long-term bears in there as well. About 1 in 5 of you think that's 2021 and beyond. So I suppose from that perspective, if that's your view, you would be only hedging short-term at the moment. Should we take a couple of questions, Limo? See what people have been firing in. They've been coming in thick and fast, so that's really good. A few comments and a few questions in here.
There's an interesting one here. Are commodity prices expected to provide a floor in power prices going forward, and to what extent does that differ by state? Have you got a view on that, Aidan?
Yeah, and I suppose we started to see some of that clearly. That low gas price is having a greater influence on Queensland at the moment, forcing out coal gens and gas gens taking advantage of that cheaper gas. So I think certainly you will see that having an influence. Will they provide a floor? We've seen the oil market turn negative and start to correct. So arguably that the oil price has found a floor for now. The floor price, I suppose, in the Australian gas market is increasingly being linked to the world stage through those LNG contracts, but also the cost of production or cost of extraction, liquefaction, etc., and transport for the Australian producers. So I think you're probably looking at a floor somewhere in the $3 to $4 a gigajoule range. So we're probably near that at the moment for gas. And that's also aligns pretty well with the netback price of gas. So the equivalent cost that an Australian producer could get if they sold their gas into the international market. When you look at the forward curves for gas in Europe and other Northern Hemisphere buyers of gas. So I think yes, you will see you will see a combination of natural cost of production as well as that oil indexation influencing that netback price to put a bit of a floor in the market, probably in the $30 to $35 a megawatt hour range. Coal to a lesser extent at the moment because of those long-term contracts in play, but more so from the gas side.
Yeah, great. There's a question here. Has there been a demand shift from SME, that's a small medium enterprise, and large customers to residential? I think I can answer that. The short answer is you can't tease out that information in the demand data from AMO, not to any appreciable degree. We're more likely to see that impact reflected through data that may come out of the Australian Bureau of Statistics, where they will, look at the slowdown in the economy and how that's impacted various verticals and categories in the market. I think that will be a better indicator of if we have seen a shift to residential consumption. But I think logically we will see a change. We will have seen some change in residential consumption as people are homeschooling and working from home and using a fair bit more energy during the day.
Thanks, Limo. There's a sort of couple of qualification questions here. Why do we call them baseload futures for the ASX prices? And that's really just a 24/7 contract, so a block of energy for every hour of the day, and that typically is what underpins the standard retail deals. It's a bit of a proxy that baseload contract is directly related to retail prices. It breaks down a little bit in the residential sector and for certain size customers, but by and large, a significant move upwards or a move downwards in the baseload contract market it should translate through to a similar sort of move for the commodity piece of an electricity retail rate. Lots of other good comments in here.
I was going to say, have you got any view? We've got a question here. If you've got a view on heading out to as far out as 2024, comparing that to what we're looking at for the 2020 to 2023 futures prices.
Yeah, so the forward market, I dropped a couple of quarters off our chart because the futures market is not particularly liquid for Q1 24 and Q2 24, but you can see prices out that far. In the over-the-counter market, you can certainly trade out that far, and so prices are available out there. I'd expect you'd be seeing, if you looked at a 4-year retail deal, something very similar to that 3-year price. Retail is very interested to lock you into a real long-term deal. So again, I think it'd be priced very similarly to CY23 at the moment, where you can get a price. Is that justified based on the view of fundamentals? I think that long-term view is still around stronger fuel prices through the back end of the decade, further retirements or shutdowns on the thermal generation side, partially being offset by some of the renewable capacity. So I think at the moment the market is probably right to be pegging 24 about the same level as 23. It's just so far from delivery at the moment. It's so hard to know the true supply-demand dynamics at that time, as well as the fuel price market. I mean, you know, how quickly has the market responded to the changing situation that we have at the moment? So much can happen in a quarter, let alone 3 years. So I think at the moment 24 priced about the same level, probably not a bad buy for most sort of conservative consumers. If they want to get that locked away, they shouldn't be too far out of the money at the end of the day, but obviously there is the risk of movements in both directions, and drivers there with the renewables potentially keeping prices depressed, with the thermal supply side to potentially support prices as a result of retirement. So yeah, sort of hedge my bets in both directions, but I think at these levels, if you can lock in, they'll look reasonably good for businesses to be able to continue to focus on core business in 4 years' time, and if they take long-term contracts now.
Yeah. Do you think there could be any impact on the market? So the next major coal-fired generation retirement that's been announced is Liddell Power Station in New South Wales, a major around 2,000 megawatt power station. We haven't seen that priced into the forwards, that reduction from capacity in the market.
Yeah, I mean, so you've got to see it progressively get priced out of Q1 22 and then Q1 23. I think the schedule at the moment is for 1 unit to exit in April 22, and then the final 3 units to go at the end of Q1 23. So arguably you should see quite a big step change into that Q1 24 contract relative to the Q1 23, if you follow my logic. In New South Wales, does 1 unit leaving the difference between Q1 22 and Q1 23, is that meaningful? Probably not at this stage and not this early out. So you don't see a major difference there. If anything, I think Q1 23 is priced on par, if not slightly below its 22 equivalent. And then Q1 24, I'd say there's just not enough liquidity at the moment. Fundamentally speaking, yes, you could mount a story that says it should trade slightly higher in the absence of those units at Liddell, but also through that time you're going to have significant obviously renewables to continue growing and potentially dampen the influence of Liddell's retirement. But I mean, you hit on Hazelwood before. I mean, that obviously caused quite significant shockwaves through the market when it retired. So certainly don't discount it as an influence, but in the forward market you don't see it at this stage.
Yeah, interesting. Very interesting.
Yep.
Take a couple more questions. Perhaps this one's an interesting one. Someone's asked, we've talked about reductions in market pricing, but someone's asked what affects the market regarding increases in prices. So certainly, we're talking about market lows of 4 years or longer, the lowest prices we've seen in 4 years or longer. But that will start to increase at some point in the future. So have a little bit of a chat about what will drive some of those increases in pricing once again. I'll probably make some comments on spot pricing. It's a large amount driven by demand and the way the bid stacks happen. So particularly if we're talking about sort of the underlying or sort of the median prices, then that's going to be driven by demand. So we will see a bit of an increase as we move into winter and some of those heating loads increase. Industrial demand always has a significant impact. Industrial demand drives the majority of demand in this country. And we often see, in terms of sort of opportunistic bidding, prices driven by traditionally the thermal generation, the dispatchable generation, when there's a shortage of renewables, particularly in the early morning and late evening peaks. We see opportunistic bidding driving the price quite high, which pushes up those underlying market prices and can flow into the futures markets.
Yeah, I mean, ultimately it only comes down to one generator to set the price in any given region, but all of those other factors drive who that marginal generator is at any interval of the day. So yeah, they all play their part. Probably the last point here is someone's asked the question, and this will be a really nice segue for us into our next week's On the Spot. Why the focus on spot prices? And so I mentioned at the start of the session, Flow Powers has a slightly different business model to other retailers, and really core for us is connecting customers to the wholesale price. And so all of our customers in our portfolio have some direct exposure to the wholesale market, either through exposure to the absolute pool price or spot price, or through the exposure to the shape, and work like the team that Alex sits in, the engineering team, they support customers to help understand how they're consuming, what's happening in the spot market, and to optimize their opportunities there. And one of the key topics of next week's On the Spot will be taking a look at that shape factor, how it's calculated in our retail products, and how you can have a really positive influence on it to save your business money. So please encourage you to join back on to next week's On the Spot, where we'll dig into a bit more detail about the retail products that allow you to extract value from either the spot market directly or through that shape factor. Thanks for joining, Limo. Thanks for coming back on. Hopefully we didn't break things in Nathaniel's absence, but look forward to chatting to you again, and thanks for sharing your knowledge.
No, pleasure. Thanks for having me on, Aidan.
All right. See you, everyone.
Cheers. Thanks all.